One of the reasons why my housing market analysis of April 2019 was more subdued in terms of the prospects for US house prices than it would otherwise have been is because the yield curve was flirting with inversion. That I concluded that the Fed would not allow to take place and thus adopt whatever means were necessary to prevent inversion that tends to foreshadow lower inflation and economic recessions. The Fed succeeded in preventing a sustained inversion during 2019 with the yield curve massaged to hover around 0.2%. That is until the pandemic broke and the Fed panicked and opened the monetary floodgates once more, as it periodically does, the most significant example of which is the financial crisis that sent the yield curve soaring to currently stand at 1% as the bond market is discounting higher future inflation as a consequence of rampant money printing. A steep yield curve is signaling future inflation, more money printing stimulus, which is good for house prices because basically investors are selling long dated bonds to buy inflation proof assets such as housing. So the yield curve trend is strongly bullish for US house prices. US debt. Of all the noise the politicians make, the reality is that Democrat or Republicans both are socialists in the practice of deficit spending, as the graph illustrates that if one ignored the pandemic crash, then one will be hard pressed to see the difference between, for instance, the Obama and Trump years. The US debt mountain has now passed $27 trillion, 100% of GDP, after adding nearly $4 trillion to 2020's total. What are the consequences of the US government printing and spending $4 trillion during 2020 and at least another $1.5 trillion during this year? High inflation, high real inflation. So what should you do? Invest in assets such as real estate that cannot be easily printed. Thus, in this one graph you have the housing bull market smoking gun, all whilst the perma fools continue to bang the decades-long drums of always imminent debt bubble bursting deflation, all whilst the money printing induced inflation megatrend continues on its exponential trend trajectory. Did the coronavirus pandemic deliver the perma bears the US house prices crash that they have been crying so loudly for over a decade now? Firstly, a recap of my existing US house prices trend forecast as of April 2019, which forecast a rise in the Case-Shiller index from 225.9 to 232.4 as of January 2021 data. And here is the updated chart for what has transpired since my forecast of April 2019. So whilst the US stock market had a panic attack into mid-March, the crash where the US house prices are concerned was upwards, which should not have come as much surprise to those who have been following my analysis for the past 10 years, i.e. money printing on an epic scale. When you know the Fed is about to print a shitload of money, whatever they call it, will mean that assets that cannot be easily printed will surge higher in price. This is the inflation megatrend in action. The primary megatrend is the inflation megatrend. Those who bet against it on hopes of a repeat of the 1930s depression will keep going broke. That's if they put their money where their mouth is. This video is an excerpt from my recent extensive in-depth analysis that concludes in a detailed trend forecast for US house prices into 2022. The whole of which was first made available to patrons who support my work. So for immediate first access to all of my analysis and trend forecasts, then do consider becoming a patron by supporting my work for just $3 per month, with my most recent analysis concluding in a detailed trend forecast for the stock market for 2021. And my schedule of analysis includes a major update on which AI stocks to invest in for 2021 and beyond, a look at the prospects for UK house prices, a Bitcoin trend forecast update for 2021, not forgetting that my last forecast to buy Bitcoin at under 10k, and a piece on how to get started on getting rich, how to actually get rich. And then an update for the prospects for the US dollar and sterling, as the British pound has now fulfilled my long-standing target of reaching 1.4 to the dollar, or $1.4 to the pound, should I say. And do remember to subscribe to this YouTube channel for new videos.
Why did we do that? We did that because the Secretary, look, I was there when the Secretary and the Chairman of the Federal Reserve came those days and talked with members of Congress about what was going on. It was about September 15th. Here's the facts, and we don't even talk about these things. On Thursday at about 11 o'clock in the morning, the Federal Reserve noticed a tremendous drawdown of money market accounts in the United States to the tune of $550 billion was being drawn out in a matter of an hour or two. The Treasury opened up its window to help. They pumped $105 billion in the system and quickly realized that they could not stem the tide. We were having an electronic run on the banks. They decided to close the operation, close down the money accounts, and announce a guarantee of $250,000 per account so there wouldn't be further panic out there. And that's what actually happened. If they had not done that, their estimation was that by 2 o'clock that afternoon, $5.5 trillion would have been drawn out of the money market system of the United States, would have collapsed the entire economy of the United States, and within 24 hours the world economy would have collapsed. Now, we talked at that time about what would happen if that happened. It would have been the end of our economic system and our political system as we know it. And that's why when they made the point, we've got to act and do things quickly, we did. Now, Secretary Paulson said, let's buy out the subprime mortgages. That's what he came to Congress. But he said, give us latitude and large authority to do many things as we decide necessary, and give us $700 billion to do that. Shortly after we enacted our bill with those very broad powers, the UK came out and said, no, we don't have enough money to buy toxic assets. Instead, we're going to put our money into banks so that their equity grows and they're not bankrupt. And so the UK started that process, and that's true. It was much cheaper to put more money in banks as equity investments than to start buying their bad assets, because it became early determined that we'd probably have to spend $3 or $4 trillion of taxpayers' money to buy these bad assets. And we only had $700 billion. So Paulson made a complete switch, went in and started putting money in buying securities and reinvesting in the banks in the United States. Why? Because if you don't have a banking system, you don't have an economy. And although we did that, it wasn't enough money, and as fast as we did that, the economy has been falling. And the reason last week, we're really no better off today than we were 3 months ago, because we've had a decrease in the equity positions of bank because other assets are going sour by the moment.